1921. Basically what it allows is that if you sell a property that's held for investment, basically anything that's not your primary residence or vacation home, and you reinvest the proceeds into other real property, it doesn't trigger a taxable event. You basically rolled over your gains from one property to another, didn't become liquid, you never touched the funds, and therefore you kind of keep going. And so it is core part of real estate investor strategy, right? And a thing you hear about a lot, but not something I had spent a lot of time thinking about or dealing with. And then I think some of the other things that were interesting is like, of the property that could be exchanged, something like sub 10% property does get exchanged. So even though maybe $100 billion is exchanged per year, there's maybe a 10x larger opportunity if you figure out how to get people to do more exchanges, which would be very cool. And exchanges is good. People look at it as like a tax hack, but I actually think it's cool. It takes kind of appreciated, under-leveraged, underutilized capital that's tied up in one thing, and it encourages you to move it to something else and to redevelop other properties and to stimulate the economy and find the highest and best use for real estate by taking these like stodgy old depreciated properties and moving the money around. So I think it's a cool part of the tax code that spurs economic activity. But again, pretty esoteric. Nobody knows about it.